Well, welcome back to another episode of Finance Uncut. On today's episode, we're going to ask the question, are we headed for a market crash and high inflation? And in this video, we're going to have a look at an interview done by former hedge fund manager Jesse Felder. And towards the end of the video, I'm going to give my synopsis where I think we may be heading to a 1973-74 type market and economy.
How concerned are you about either of those? About the economy's ability to get back to sustainable economic growth, and then how concerned are you that the markets, if they're not fairly valued, that might be overvalued?
Well, I do think, that a lot of the economic boom that we're going to see is not just pent-up demand, but it's also, going to be a product of all of the fiscal stimulus that we've seen. I mean, unprecedented amount. Biden's trying to pass, another whatever it is, $2 trillion of stimulus, $1,400 checks that are going to a lot of people who don't necessarily need them. And that's, I think that probably also helps to explain what the stock market's done. To me, I addressed the economy in that first segment, but I didn't really address the stock market. To me, when I look at those valuation metrics like the Warren Buffett yardstick, as I call it, which is just market cap to GDP, we're 30% plus higher than we were at the peak of the dot-com mania. So if you think about that, I mean, the stock market would have to fall 30, 35, 40% just to get back to the peak valuation we saw in March of 2000. To me, that is just absolutely astounding to see valuations so just off the charts right now. And what a lot of people have been saying, I mean, valuations have been high for a long time, but we haven't seen the retail speculation kind of come into the market until the past 12 to 18 months, really. I think we started seeing it pre-pandemic. And then in the March crash of last year, we saw retail really jump in with both feet. And I mean, you can see it in a number of Robinhood accounts that are being opened, volume, in penny stocks. You can see it in options, the volume in call options. To me, it's crazier than anything we saw during the dot-com mania. And so I think we have sentiment, valuations, all these things pointing to me that we are witnessing a blow off, mania like we've rarely seen before.
And this is what Jesse is talking about. The Buffett indicator, the market cap to GDP, is at all-time highs. It is, as Jesse said, about 30% higher than the peak of the dot-com bubble mania. And so this is a concern. And the problem is when you start buying at the peak, then your future returns over the coming decade is very, very low. In fact, Jesse's going to share shortly how he thinks, and some experts think, that perhaps the returns for the next 20, 25 years aren't going to be great. And in fact, if you have a look at the 1929 peak, we did not get back to that peak for 26 years after that. When we look at the earnings and the S&P, so the S&P is almost 4,000 points now, and earnings, because of the cerveza sickness, have fallen through the floor. But really, for a little while now, the price of the stock market and earnings have broken away from each other. But right now, I'm sure you all know that there's a real economy which is in a depression, depression 2.0, and the stock market and financial assets are skyrocketing at the moment. The CAPE ratio, the Shiller CAPE ratio, is right up there with the 1929 bubble. On this metric, the dot-com bubble is still more expensive. So look, can the stock market continue to run higher, and can financial assets continue to run higher? Of course they can. Of course they can. I'm not saying that this bubble has popped or it is about to pop tomorrow, but buying at these prices is very dangerous stuff. When you have a look at the central bank liquidity and the big tech stocks, if you want to put it that way, there's a very good correlation there. So as the central banks create bank reserves, and obviously when they're buying from non-dealers, so when they're buying from insurance firms or hedge funds or stuff like that, so buying bonds, that is, then those hedge funds and insurance firms are actually getting newly created cash, and that goes straight into the financial markets and generally goes straight into these big type stocks. And so we're seeing that. There's also other ways that the when the central bank creates bank reserves for the dealer banks, that they can then lend to their investment arms and into other financial institutions and hedge funds and whatnot, that then take that newly created debt and go and invest into financial assets. We have a look at the US total equity and index call option volume. I mean, once again, I don't want to do too much talking in this video. I want these slides and Jesse to basically do all the talking. You guys can see it for yourselves right here. And margin debt to GDP has never been higher. So everybody's jumping in on options, on leverage, margin debt, leverage. The dangerous thing about this is when it starts to fall, and it doesn't have to fall a heck of a lot for some margin calls to be done. And I've experienced this myself many years ago during the global financial crisis. I had some margin debt against some of my portfolio, and I received a margin call, so I know what it's like, and I had to pour more funds into it. I got a second margin call, and I decided to sell, and it was probably a wise decision because that kept going down and down and down and down.
One of the reasons why there's so much capital in the markets is because we have killed the incentive to save. We've basically treated or taught our society to not be savers. We've said, look, if you're going to keep your money in cash, you're going to get punished, right? You're going to get no return on it. It's going to get eaten away by inflation. And to your point, look at all these other people who are getting rich, easily, buying into all these other assets. And so, people are getting pushed, across the risk curve to increasingly higher and higher risk to get any return on their capital, right? And now what we're doing is we're basically killing the mindset of investing, and we're really replacing it with a mindset of speculating, right? So what we're going to do is when this bubble bursts, if indeed it does, I fear the collateral damage is we're going to end up with a society or a populace that has been trained not to save, been trained not to invest, and they don't want to speculate anymore. And I don't think that's healthy for anybody.
Yeah, I mean, it's absolutely. I mean, think about the missed opportunity for so much good work that could be going on for people to be spending their time doing things that are actually productive,
and capital that could be productively applied
absolutely.
too. Right?
And so it's hugely problematic in that respect. And you're absolutely right that we have created more and more a society of consumption, and that's you can't talk about this without talking about the Fed and the interest rate policy and consistently trying to pull demand from the future. And I've been wondering for a few years now, okay, where do we get to the point where we've pulled all the possible demand from the future that we can, and then there's just a vacuum of demand because everybody's bought everything they wanted to buy. I think we're sort of seeing that, in terms of, you look at loan growth at the big banks and credit cards being paid down, a lot of that's people haven't been able to spend. And so there is that pent up demand. But, the banks have been, having a hard time making loans for years now. And they're trying to get, money's essentially free. And so this is why the Fed is so afraid of the zero lower bound, as they call it, because you get to the point where you've essentially taken rates to the floor. You can't go any further, and this game of pulling demand from the future just stops working. And so I think that's probably a risk that the markets don't really appreciate enough. And the flip side of that too is the Fed keep continuing to push in this direction. There's going to be inflation, and to me right now, that's the biggest risk to markets. Markets are pricing in low interest rates for as far as the eye can see, and low inflation for eternity. And so any hint that rates are not going to stay low forever, and that inflation is going to be a problem in the near future, means a lot of these trades have to be unwound. And to me, that it spans everything from SPACs to cryptocurrencies to growth stocks. They're all potentially at risk to this. Even inflation just even barely rearing its ugly head. But we'll just have to kind of pay attention to that.
So I wanted to stop this video on this chart and just show you, here in red, we've got the margin debt rate of change. And what's interesting, whenever it's got to these levels, so this is now, it's always led to a severe market correction here. The only time it didn't happen was in 1983. However, this video, I want to focus on this period here, 1973 to 74, because I think, and I stress that I think, we could be seeing this little scenario playing out now, or at least very soon. Let's again have a look at the trading volume. Trading volume. So everything is just on another planet when it comes to the amount of trading, the amount of margin debt, the amount of call options. These slides, graphs, whatever, they speak for themselves. You don't need me to speak and talk about them. US tech stock earnings, as these stocks continue to skyrocket, their earnings yield is going down. In fact, the earnings yield now is down towards the tech bubble. Once again, what do you think? Is it a great time to buy? Yes, it could go higher, but I do not like the returns for the next decade in these stocks. Is Bitcoin the mother of all bubbles? Well, I'm not going to talk about Bitcoin and whether or whether that is a bubble or not. I'll let everybody else decide. But what I do want to focus on is the global debt bubble. Because this is the problem that we've got at the moment. We've got this global debt bubble, and central banks and governments are trying to keep air in this debt bubble to keep it from popping. Because if it pops, this is going to be the biggest crash, the biggest depression, the biggest problem that any of us will ever see in our lifetimes. However, they could create some other problems. Obviously, inflation, hyperinflation, and you'll hear from Jesse talk about, I think it's Bill White, who's the former vice president, vice chairman of the Canadian Central Bank, talk about the issue around inflation and debt and interest rates and so forth. But this is what I want to talk about in this video. So we've got a global debt that's actually pushing $300 trillion now. 21% of all US dollars were printed in 2020. I mean, just every graph we're looking at, 2020 is just, it's not comparable. People want to compare this to the GFC and how QE didn't create inflation. Well, there was inflation. There was around 2% inflation throughout that time, and you'll see what 2% inflation over a long period of time actually does to someone's purchasing power. But this is different. We've got huge fiscal spending directly into household and businesses' back pockets. We've got central banks in Europe, ECB, are now funding 85% of all new bonds issued from governments in the EU. And speaking of Treasury securities, you can see from foreign holders, so there's foreign investors buying US Treasuries, the trend speaks for itself. It's going down and down and down and down. And while that goes down, that means the Fed has to pick up the tab. And so the Fed is picking up the tab, as you can see in this slide, in this graph. And as I said, in Europe, 85% of all new bonds being issued are being picked up by the ECB. People are now moving away from buying bonds. Why would you buy a bond? And Jesse's going to talk about this in a sec. Why would you buy a bond that gets you maybe 1.5% if inflation's at 2-3%?
And just a little bit more on the inflation topic. To me, I view this as the Fed is going to have to make a choice between, I frame it as between the devil and the deep blue sea. When inflation starts picking up, they're either going to have to raise interest rates to fight inflation, and you're going to get an asset price bust, right? You raise rates as soon as they start, hinting they're going to raise rates, the asset markets are going to start to wobble. If they are forced to raise, rates, to 1, 2, 3%, I mean, you get the risk-free rate at 3%. There's no way you're going to be able to sell a single SPAC. People are going to lose interest in Bitcoin and these types of things. And so either they do that and risk the another asset price bust, which is the devil they know, or they say, you know what? No, we are going to let the economy run hot. We're going to keep rates on the floor, regardless of what inflation does. And then you risk the prospect of hyperinflation, which is something that William White has talked about. And he said, when you get a government that is highly indebted, very low interest rates, and inflation picks up, and you can't raise rates because everybody would immediately realize the government can't afford higher rates. The government would essentially be insolvent without money printing. That's when inflation goes out of control. And so that's the flip side of it. So I think, Jay Powell and the Fed, they're going to be faced with this very important decision. And it's, neither outcome is very pretty.
A tweet I wrote yesterday where I was sort of retweeting another tweet which had cost increases for most of the major assets that we sort of depend on for a living, right? Lumber, metals, agricultural commodities, that type of stuff. And they're all up double to triple digits over the past year. And then the CPI came out, the core inflation rate of 1.4%. And I think everybody, has their opinion that that's a highly manipulated number, but it's so funny that they expect us to believe that inflation's trending only about 1.5%, when all of the things we literally depend on to live are going up by, double to triple digits annually.
Yeah, I mean, the only thing you need to do there to understand that is replace owner's equivalent rent with actual home prices. And if you do that, inflation's running 2.5-3%. So,
yeah.
I mean, it's owner's equivalent rent, this idea that we are going to poll homeowners to say, if you could rent your house today, what do you think it would rent for? And that's what we're going to plug into that inflation number, which is like 40%. It's a huge number. Percentage core CPI is this owner's equivalent rent, which is not even a real number. So it's I'm not one of these inflation conspiracy theorists, but just literally plug in a real price for the instead of owner's equivalent rent, which is a poll, and you get a much more accurate inflation number, I think.
We are seeing inflation. So, as Jesse said, true inflation numbers is probably more around 2 to 3%. If you look at some other metrics, such as this one here, we've got wheat, copper, oil, corn, lumber, etc. And you can see there from back last year to where it is now. Now this graph is a little bit old. You can see down 2018. So in the middle there, you can see average hourly earnings. But above that, there's Medicare or medical costs, childcare, college, hospital service, all that sort of stuff. What's interesting is that's all government run. So when government control things, when you have government intervention and central planning, things become more expensive. When you have free markets, you get deflation. You get an increase in your purchasing power, as you can see from the technology down the bottom. However, right now, as we just saw, inflation in food has gone up. Kraft have just announced that they're going to be passing on higher prices to consumers. Also, I just bought an air conditioner over this summer here in Australia, and that was about 40% more expensive than the last aircon that I bought a few years ago. And I was told that's due to supply chain issues, and there wasn't a lot of stock, and actually I didn't have a lot of choices there. We're also seeing used cars because of the cerveza sickness. People don't want to catch public transport, so and there's also been supply chain issues with shipping of new cars into Australia. We don't make cars in Australia anymore. We import cars everywhere from overseas. And so, and I'm actually in the car market at the moment, and so I'm actually witnessing this for myself, seeing used cars actually go up. Who would have thought that? Used cars actually going up. So we're seeing some technology, we're seeing some things like cars actually going up quite significantly, while medical costs and food now. So the things that we really can't avoid are going up a lot more. If you check out shadow stats measure how we used to measure inflation from the 1970s, 80s, and 90s. And according to them, inflation is running in the high single digits if we use the same metrics that we measured inflation back in 1980. And once again, in shadow stats, if we're using the 1990s model of measuring inflation, then we're looking at around 5% inflation. And I think that's probably about where we are. And if you heard what Jesse said, really inflation from what he thinks is definitely around that 2.5% to 3% mark. And this is what low inflation looks like, folks. So this is your 2 to 3% inflation that your central banks and government say is great for the economy. 2 to 3% means we're growing, blah, blah, blah. That's all rubbish. That's Keynesian rubbish. It's just absolute trash. That is stealing nearly half of your purchasing power over a 20-year period. So from 2000 to 2020, 2 to 3% inflation, that's nearly half your purchasing power gone. So, for your retirees who are sitting in fixed income, sitting in cash, all our workers, our low to middle income earners who don't have financial assets, that are just working hard and saving a portion of their salary, well, you guys are getting screwed. You're getting screwed.
I think probably the Fed has said they want to let the economy run hot. And I think, that this is why I had, you mentioned John Hussman, he has said to me, he thinks it's possible that we've pulled forward as much as 25 years worth of returns now forward into this stock market. We could have that long of a kind of a Japanese style, bear market. But I also had Daniel DiMartino Booth on my podcast recently to ask her this very question is, how much hubris, right, is involved with this decision to let inflation run hot? To me, it's you're playing with fire, and I worry more about that side of it, because if they do keep rates low, I mean, they'd have to use yield curve control to also make this happen. Even if inflation's picking up, you risk this spiral, and I do think, even if you do get that kind of a hyperinflationary spiral, and I'm not talking about inflation in the teens. I'm talking about if you are holding interest rates at 0 to 1%, 2% maybe across the curve, 6% inflation is, very, very problematic. And so, I do think that that's probably the route the Fed's going to go. They're going to try and use yield curve control in these things, but that in itself might create an asset price bust. If inflation's running 5-6% and you're getting nothing from risk-free assets, and I'm sorry, from treasuries, that like I said, it's not pleasant to think about either route. But I think if inflation is running 5, 6, 7. People are not going to be excited about, buying a SPAC, or that type of thing that offers no dividend, nothing. And so, it's right. I mean, it's impossible to game, but I do think that the Fed has said that that's what they prefer inflation to run too hot. And so I think that's the road we're headed to.
So this is a really interesting chart. And being a student of Austrian economics and sound money, when we look back between this period of 1774, I like to use 1790, through to 1912, just before the Federal Reserve was created, we actually had average annual deflation. But a lot of people will go, oh, well, if we had that, then people would have been worse off. Workers would have been, that would have been just a terrible time to live. However, when you actually have a look at the wages during that time, wages went from $37 a year in 1790 to $171 in 1912. So wages actually went up 462% during that period. While your living costs almost halved from 1790 through to 1912. So think of that today. Imagine, you're on $100,000 a year today, and let's say your expenses are $100,000. So you're living week to week, spending everything you earn. Well, by the end of the century, yes, you're going to be carked it, but your income is now $462,000, while your living costs have dropped to $50,000. So that is actually an increase in your standard of living. But now we've got this central bank, and since then we've had all sorts of issues, moving off sound money, fiat currency, inflation, and this hurts workers. This is a decline in living standards. And check out the website WTFhappenedin1971.com. You'll see when Nixon closed the window close the gold window, we just see everything from wealth inequality gap completely going in opposite directions. We have workers' wages to productivity splitting. All of our economic problems are caused by having a lack of sound money, sound currency, and having sound economics. We've got this Keynesian model, government intervention, central planning, and it just makes things worse. Now, if we do see the bubble pop, if we do see financial assets pop, this is going to be a key driver. The US 10-year yield, it is on the march up, obviously from the lows in August. It is on the way up. So this is more than doubled from its bottom. In fact, we'll be pushing almost a triple increase from its bottom. But if this continues to go up, what does the central banks do? Do they come in and do yield curve control, which a lot of people think? Now, the Australian 10-year has increased dramatically, and our central bank has announced that they are going to buy more bonds, that they are effectively going to try yield curve control and continue to do quantitative easing, as well as try to put a cap on our Aussie dollar. I'm not 100% convinced that this is going to work. It may. Obviously, we'll wait and see, but they're going to have to print and buy a heck of a lot of bonds to try to keep yields down, because as inflation starts running away, yields are gonna pop, and so we'll see what the central banks do and whether they can actually do anything about it. I'm not 100% convinced on that.
So how do I prevent myself from becoming collateral damage in this world? So Jesse, you're a researcher, as you sort of look ahead and advise investors, what are some of the things that you're seeing, and what are some of the sort of general considerations that you recommend people, contend with and think about here in terms of, at a minimum, trying to preserve wealth going forward into this environment, and B, for those that are sort of looking to position themselves to, maybe get some prudent growth in there, what sectors they might be looking at?
Well, I think I've been writing for at least 5 years now that, you need to own some real assets. Gold, has performed really well over the past 5 years, but I do think generally most people are focused on stocks and bonds, financial assets only, and they don't think too much about real assets. And so I do think you got to have, a significant allocation to real assets, whether that's gold, commodities, tips, real estate. I do think there's still a great deal of value there. I think in terms of equities, I'm limiting my equity exposure as much as I possibly can. The only equity exposure I really want to have right now, to me, I've been just pounding the table bullish on the oil patch since last fall. Back September, October, to me, these oil and gas producers, so many of these stocks, they reminded me of the gold mining stocks back in late 2015 or very early 16. They're completely left for dead. The stocks were basically pricing in bankruptcy, for most of them. And you had a guy like Harold Hamm, who's, okay, well, I'll back up the truck and buy $150 million of my own stock with his own money. That's Continental Resources. So there's stocks like that to me, are special situations that I think are fit in line with that inflationary framework. I do think that, I mentioned the economy could boom when it fully reopens. Part of that, could lead to oil shortages. I don't think people really appreciate that the fracking, the shale sector can't just come back online as quickly as it has in the past. And so there's opportunity to me in energy, and that's really the only sector in the there's probably some relative value still in the financial sector also with the yield curve steepening. But generally, I want to limit equity exposure. I want nothing to do with bonds. To me, getting paid little over 1% on a 10-year Treasury note when inflation's running well above that makes zero sense. I want to make sure I have a significant allocation to gold and probably some other real assets.
So I think that we could be heading for a 1973-74 type of environment. I think we could see a significant correction in the stock market. I think at the earliest this could happen probably around April, just with a few things that I see. But really, it's probably more likely in the second half of 2021, as we do see the vaccines being taken, lockdowns ending, and we really see inflation's head really jump up in a significant way. Because when inflation jumps up, and if rates do move, if yields do move, then financial assets are going to be hit hard. So I think we could see a downturn in the market, and so I'll share what I'm doing in a sec with that. Now, a lot of people say, but Steve, if we're going to get inflation, then stocks should do well. You don't want to hold cash because that will get burned. So let's buy financial assets. Let's buy stocks. However, if you have a look at the 1973-74 bear market, where the market crashed, I don't have the figures on me right now, but it crashed a lot during this 2-year period, folks. Don't forget that this is a 2-year period that we're looking at. So picture that now, 2021, right out to the end of 2022 or 2023. That's what we're talking about. So yeah. So here's the thing: is inflation during that period, 73, 74, hit almost 12.5%. Okay, so we had a market crash of significant portions over that 2-year period while inflation was high. So stocks are not a hedge against inflation. They aren't. It's real hard assets, gold, silver, other commodities, real estate. It's real assets, real hard assets. And that's what Jesse said, hedge, get hard assets. They're what at the moment everyone's in financial assets, like Jesse said, stocks, bonds, etc. I think now's the time to, actually I've been investing in hard assets for about 12 months, actually probably a bit longer than 12 months now, actually before the Cerveza sickness, but I've gone even harder since then because of everything that's happened. So no, stocks are not, if we get inflation, which is my base case, I think we do get that. There is a chance for deflation. There is, I acknowledge that. There's no certainties in this game, only probabilities. Then it'll be interesting to see what happens. I think my base case is for inflation, and if we get that, then that's not good news for stocks. That's not good news for stocks at all. Now, just have a look at so basically from 1968 through to 1982, inflation adjusted, the S&P went down. It went down 63%. So folks, that's 14 years. Stocks are not a hedge against inflation. They're not. You need real hard assets. In fact, if you go back to, as I said earlier, the peak in 1929, well, if you draw a line across there, you're going into the 80s. Yes, you can see in the 60s that it did go up, but then we've had the real crash, or the real inflation-adjusted crash throughout the 70s. So it actually wasn't until the mid-80s before you actually got back to that kind of high of the 1929 peak there. So just got to be very, very careful investing at these nosebleed valuations, at this bubble type situation. Just got to be so careful. And in here we can see, so look in the 70s there, so we're looking at that 73, 74 type period. You've got in yellow the Dow Jones Industrial in gold, absolutely crashed when measured in gold. Okay, the Dow Jones in orange, you can see during the 60s and 70s period there, it was flat at best. So it went sideways. In fact, it did kind of slightly go down, but let's say it went sideways. Okay, so in that sense, it went sideways. S&P, it went down. In real dollars, it went down. So you can see there from kind of late 60s through to the early 80s, it went down. What did the best? It was gold and silver. And you can see that when measured against gold, the Dow absolutely crashed, which means gold went up. So what am I doing? Yes, I am taking some risk off the table. I am taking some profits. I've shared in my investment thesis video, I think it was video 2, maybe video 3, don't quote me, I think it was video 2, about my returns, my 2020 scorecard, and some of my positions made 200, 300, 400%. And so some of those I've taken off the table. I've taken some risk off the table. As you know, I'm heavily invested in gold and silver, both physical, but also in the mining and explorer space. So I still have those positions in those miners and explorers. So yes, I still do own stocks. I haven't sold everything. I've got stocks in certain commodities: copper, nickel, cobalt. I know there's another one, zinc. So I do have. I've since exited positions in iron ore. I've exited positions in coal. I've made some profits on those. So I've taken some risk off the table. I am sitting in some cash. Now I know that sounds bad, but as you heard Jesse, it's not too bad. And why am I sitting in cash? Well, in March last year, we did short the market. We bought put options on individual stocks, and we made 780% return in about 2.5 weeks. So I want to have some dry powder to do that play again. Now we're going to wait. We're not going to be early. We're going to wait. Happy to be late to the party. I don't want to be early to the party because this market can go up a lot further than we can remain solvent. So we're going to wait, but we're building some dry powder to short the market when we think that the market has turned and is heading down, because then we'll make significant gains if we're right. So we're definitely doing that. Still bullish on commodities. So real commodities, real estate in Australia, I'm not 100% confident on. I've got some concerns and worries. So we're monitoring the data here. We're seeing what's happened at the moment. We get the feeling that that it's huge government support that has been keeping that up, amongst a few other things. We just wait and see what's happening there. We think there's a lot better gains in the commodity space than in real estate. So that's where we're heavily invested at the moment. So once again, this isn't financial advice. This is just me chatting on YouTube, and hopefully a few of you folks watching, and I don't know, thinking maybe this guy speaks a little bit of sense of something. But anyway, that's where I'm positioned. That's where I see things. Obviously, if there is deflation, my gold will do well compared to stocks and other assets. I'll have some cash, so that will do well. So if that does happen, then cool. I am hedged for that as well. But my base case, as I said, is for inflation, and so we're going to go for that. However, I do think that even though we're going to see inflation, I actually think there's a good chance that that we're going to see a 1973-74 type of market where the market crashes while we've got high inflation. So let's wait and see. Maybe I'm right, maybe I'm wrong. Who knows? That's what I'm doing. If you guys like the video, hit the like button. If you haven't subscribed, hit the subscribe button so you get all my new videos when I put them out. Once again, love to see your thoughts and opinions in the comments below. Do you think I'm completely off track here? Do you get a sense that the market's about to crash, or do you think this is going to continue to go up in the years ahead, and this crack up boom continuing? So anyway, thanks for joining me, and I'll see you again on another episode of Finance Uncut.